Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, we're taking a look at U.S. T-bills and asking the question, why are T-bills selling at auction below the benchmark rate set by the Federal Reserve? The U.S. government funds its activities by issuing Treasury securities and T-bills in order to finance the government. U.S. Treasuries are long-term bonds and T-bills are short-term instruments. If you go to treasurydirect.gov, you will find the place to buy T-bills at auction. You'll also find a lot of statistics on T-bills, their prices, and in fact, who's buying them. On today's show, we're going to focus on the market for T-bills only to try and understand why there's an apparent shortage of this paper. Demand is exceeding supply, and why is that? It doesn't seem to make sense. Is the market saying that they want the U.S. government to spend even more money? Do they want to see even greater deficit spending? To understand this, we need to understand the Federal Reserve Act and why the Fed is even active in trading securities. If you go back to World War I, the U.S. government wanted the newly created Federal Reserve to finance America's growing commitment to the war and the financing through Liberty bonds. But the Federal Reserve Act specifically prohibited the financing of speculative government activities, and the war would have been considered a speculative activity. The Fed created a workaround. Because the Fed was not to burden the taxpayer, the Fed reasoned that they needed to have earning assets on their balance sheet in order to fund their own activities. And that opened the door for the Fed to purchase and sell securities, if only to fund its own activities. This was later expanded to the purchase and sale of securities from the banking system. They would buy securities from member banks and sell them back to the banking system at a later date. This was the repurchase agreement, or what we now today call repo. And of course, this is bidirectional. There's repo and there's reverse repo. The government holds a monthly auction for T-bills, and these notes sell in the open market to the highest bidder. The highest yield paid for the January 5th auction was 4.1%. But wait a minute. The current RRP rate set by the Federal Reserve, which is supposed to be the floor set by the Fed at the last meeting, is 4.3%, and yet none of these T-bills sold at 4.3%. They all sold at a lower interest rate. There were sales at 4%. In fact, there were sales as low as 3.85%. So why would these bonds selling at auction be getting less than the coupon interest rate? Why would the buyers be willing to pay extra for those bonds and accept a lower interest rate? After all, this is short-term paper. These are 4-week T-bills. Well, it turns out that auctions for T-bills are just like any other auction. Bidders make offers for T-bills, and the sale goes to the highest bidder. So why would buyers of these bonds be bidding up the price? The answer lies in the repo market. In order to access a credit facility at the Fed, or in fact the repo window at any central bank, be it domestic or international, the borrower needs to post collateral. So what constitutes collateral? Well, collateral could be another asset that the bank, the borrower in this case, doesn't want to cash out of. They just need some extra liquidity to get over a few days or maybe a few weeks of cash crunch. The collateral could be a loan against real estate, but the Fed is probably not going to accept that collateral as being of high enough quality. Collateral could be Italian government bonds or German government bonds or British gilts. But before we answer the question, let's take a look at the world of real estate. It's pretty evident that in the world of real estate borrowing, we've seen lenders becoming increasingly careful. Gone are the days of 85% loan to value. Today, lenders are also asking for higher quality collateral, and that means lower loan to value ratio. Lenders are being more selective and only lending against the highest quality assets. Lenders are asking for prepayment of interest in the form of interest reserves. They're also generally being more conservative. That's in addition to demanding a higher interest rate. Well, if we're seeing this in the world of real estate, it makes sense that banks around the world, including central banks, are demanding higher quality collateral in order to access liquidity at lower interest rates. And it turns out that if a European bank needs U.S. dollars in a dollar swap arrangement, they will need to post collateral for that dollar swap. Maybe that foreign entity needs dollars to buy oil or maybe natural gas at today's prices. So that oil gets purchased, it gets consumed in the local market, and ultimately paid for, let's say, in euros, which would then be required to convert to U.S. dollars to buy more oil. there's an ongoing and continuous demand for U.S. dollars. And those involved in the supply of U.S. dollars are not willing to accept Italian government bonds. They're not seen as high enough quality. So banks around the world are buying short-term T-bills in order to have collateral they can use for short-term credit. There is a massive collateral shortage. The types of collateral being accepted is shrinking as lenders only want the best quality collateral for these short-term credit facilities. About 22% of the 4-week T-bill volume sold in the November 29th auction was sold to foreign banks. 21% was sold to Wall Street funds. About half was sold to broker-dealers. Only 3.5% sold to individuals, and 3.2% were purchased by Federal Reserve banks. So what's striking here is that both the 4-week and the 8-week T-bills sold at auction for yields less than the federal funds rate. And this points to a massive shortage of collateral. And it's further proof that it's indeed the market that sets the rate, not the Federal Reserve. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.